Welcome to Low Country Life and Homes with Cheyenne. And today I have a guest, Danielle, and she is a senior loan officer with Carolina One. And May is Military Appreciation Month. And so we're going to talk about VA loans. We do have a large military presence here in the Charleston metro area. And so we do see a lot of that. So Danielle, tell us a little bit about VA loans.
Where do you want to start? There's so much to know about them. Well, first off, thank you to all of our servicemen and women who have previously served or currently serving or even potentially thinking about serving, right? The military is a huge part of our lives and protection for our country, so we appreciate you and everything that you do. I am the wife of an Air Force veteran.
My husband was in the Navy.
So I can appreciate a great VA home loan.
Yes, it's a great loan.
Yeah, so let's really start by talking just really an overview, right? Because we don't want to dive down too deep into it because there's so many intricacies. And the one thing, if you know anything about the government, they're not very clear on anything, right? Mm-hmm. So VA leaves a lot of everything that they are allowing up to like an underwriter's discretion, and whether there's a lot of gray areas is what I'm trying to say.
So what's an underwriter and what do they do? Let's start there since you're throwing out some terms that maybe people don't know.
Okay. So an underwriter is someone who looks at a mortgage loan, and it's not always just mortgage. It could be like for an auto loan or whatnot, and looks at basically if they're going to qualify, what risk factors do we have? Kind of documentation do we need to get? They're kind of like that person who packages everything up in a nice little pretty bow to deliver to an investor of a loan. So let's start with who could potentially qualify, right? So obviously veterans. That's a great start, right? Current active duty can qualify. Surviving spouses of a veteran could potentially qualify even if their spouse is no longer with us. Again, hence surviving spouse, right?
Would they have had to retire? Or could it be like if my husband got out after 10 years, if heaven forbid something happened, would I have access to a VA loan?
It's dependent upon what their service is, what their cause of passing may be kind of deal. Typically, surviving spouses are going to be someone whose spouse was killed in action, typically, or others who may still qualify, depending, again, what their status was.
Well, so if that's the qualification, I'd prefer to not qualify.
Right.
Thank you very much.
So the great thing is the VA it's a wide array. It does not require any type of down payment. Typically. Now, there are some circumstances where you may run into a down payment situation. For instance, if you already have maybe one or two VA loans out there, because we know that, especially active duty, you can PCS at any point in time, right? So you may have a home, not want to sell it, rent it out. And so you've used a little bit of what they call entitlement. Entitlement is what the VA guarantees as a portion of your loan. So we have our own little calculators. I'm not going to go into the details of all this because it's a lot of math involved, but we can figure out based on what you've used and what you still have available, whether or not there's going to be any kind of down payment. If you're first time purchasing veteran or you don't currently have an active loan, you haven't foreclosed previously on a VA loan, more than likely you're going to have all of your entitlement plus bonus entitlement available.
Now, is entitlement, I know you said you have a calculator, but is the calculator for after they own a first one, does everyone have the same amount of entitlement when they start? Does it depend on...
Yes.
Oh, okay.
So everybody has the same amount of entitlement when you first start. It's not anything that is like you get this much and you get this much based off of your duties and what you did, whether you're a disabled vet or non-disabled. It's literally the same amount. And it's based off of whatever the conforming allowance is in your area, again, which can vary. So when you have more expensive areas, such as like New York City, Hawaii, and places like that, their limits are going to be higher based on what a normal conforming loan would allow versus what ours is.
Question to that point real quick. Well, because you said New York. I assume you're talking about New York City, or are you talking about New York State?
New York City.
Okay.
So it's going to be definitely larger metropolitan areas, higher cost of living areas. Again, it's a lot of times county based. Okay. So you're going to find different limits depending on where your county and state is.
Do we have a large discrepancy in our tri-county areas? We have Charleston, Berkeley, Dorchester. So these are our three main counties. I mean, we also have Calhoun and Oh,
Orangeburg
thank you.
and
Where's Colleton? Thank you.
Colleton County.
So is there a lot of
Horry County and
discrepancy?
Georgetown.
So if somebody's approved for a certain amount and they're buying in Goose Creek, and then they decide, oh no, I think I'm going to go live in, I'm trying to think of a different county now, so Somerville, like the Dorchester County of Somerville. Are they going to have a big discrepancy
Same
there?
amount.
Okay.
Yep, same amount. And again, a lot of it's state county based, so it's going to be dependent upon what your normal conventional conforming loan limits are. So
And what
you're not
does
going to
that
have.
mean?
So that's what a regular conventional loan, that's like the max loan amount that you would be
Okay.
able to qualify before going into jumbo world.
Gotcha.
Okay. So please don't quote me. It's like 860 something thousand right now. It changes you every year. Like, so every year it has gone up consistently. When I started in this business 4 years ago, it was only at like 600,000 and we're already up to 860 something. That's how much the values and prices of homes have risen. So again, everybody has entitlement. There are several factors that affect that and what kind of entitlement looks like and how you qualify. So as a lender, what we do is we are typically able to pull what's called your certificate of eligibility. This certificate of eligibility is going to let us know if you've had a VA home loan, if you've foreclosed on it or did something wrong. Essentially, let's just go there. Life happens. We know that, right?
Had a negative life experience that
Yes,
kind of affected it.
exactly. And it does happen, but it doesn't necessarily always stop you from being able to utilize it again. Sometimes it can. A lot of times I have people who are not going to have any entitlement restored, but they still qualify without down payment going forward. So we get this certificate of eligibility. It shows like whether or not you're getting any VA compensation for disability. It's going to show us your entitlement code and again, any prior entitlement used. We then take that certificate of eligibility and we can utilize that based on your local area and see what you qualify for.
What documents would somebody need to give you for a VA loan? So you have this certificate. I'm assuming you still have to qualify them with other things.
Yes, absolutely. First off, most people we can pull a certificate on. However, I have found if you are reserves, maybe you have not served enough time, so you don't have a certificate generated, or sometimes just reserves is very difficult because it's not active duty. So therefore you have to provide us with additional documentation such as like your points and fees schedule and stuff of the time that you've earned. Those are all things that we would request from you to see what your eligibility is, right? Qualifying for a VA home loan is going to be the same as any other type of loan, right? So if you're a W-2 employee, we're going to get your pay stubs. We're going to get your W-2s. If you are getting any VA compensation, that certificate of eligibility is going to be enough to confirm how much of your compensation and what we can give you credit for on that. Pay stubs, dues, if you're self-employed, we're going to get your tax returns just like anywhere else. But the really, really cool and great thing about a VA home loan is unlike your conventional, your FHAs, your non-conforming or qualifying mortgages, VA doesn't care about debt to income. And I know that sounds crazy, right? It sounds absolutely crazy. However, most loans cut off at 50%. It will allow us to go up to 57% DTI. VA, I have one right now, it's 72% debt to income, and it's a pre-approval.
Get out of town.
And the reason is because the VA actually cares more about what's called residual income, and that's your money left over at the end of the month after your taxes and your mortgage payment and stuff. So there is, once again, this little chart based off of what area of the United States that you're located in, how many people are in your household, what your residual income needs to be. Now, obviously, if you're at like a 70% debt to income, we're going to multiply that residual and you're going to have more than what the VA just states, right? That's a positive factor to have much more to get the approval. But yeah, there's no debt to income requirement for the VA.
And just to put that in dollars and cents, that's basically saying for every dollar, you can have 72 cents of debt monthly. So that's huge.
That really is huge, isn't it? Cheyenne's like, I don't know if this is a good thing or not.
No, actually, I'm thinking, how can I don't know, some
Buy another
to my
house?
advantage, yes.
So, I mean, it's really cool though, right? Because you may have somebody who only gets VA compensation or Social Security income, but that income's non-taxable. So therefore, it may not look like they have a lot of money. They actually have a lot more left over than what most people would, because people are getting taxes taken out and things like that of their income. Because remember, everything's based off of our gross income, not our net. So, you know, it's actually really cool, and it's able to help people who want to get that help. The other cool thing, VA tends to have lower interest rates than most other loan programs. A VA loan does. The VA does not set that, by the way. It's per lender. You know, I mean, it's market, based on the market, but rates and all those things, none of that is set by the VA. The VA is not the person giving you your loan either. The VA doesn't like guarantee anything. They guarantee a portion with that entitlement if anything were to ever happen with that loan.
Gotcha.
So, yeah, so lots of really information that we could touch on with these loans.
There really is. So for my nuggets, debt to income, not as serious as a lot of other loans. 100% financing typically, and you can buy more than one home. You have to have it as your primary.
Right. So yeah, that's a great point, is that anytime you're utilizing your VA home loan, it has to be for the purchase of the primary. That has to be your intent at time of closing. Does it mean you always have to occupy the home as your primary? Absolutely not. You can actually, I have a client right now that I'm doing this with. He's been in his current home for 3 years. His family's kind of outgrown that house, but he doesn't want to get rid of it, right? He wants to now make that another source of income for him. So therefore, he is expanding his home and upgrading his current home, having a new primary with additional entitlement that he has. And he's going to take his current VA home and rent it out. And again, make it as an income source for himself. So you definitely can do that. But at the time of purchase, your intent has to be to purchase it as a primary residence. And you will certify that on a form, government form, at the time of closing. So please be mindful of what you're doing.
And if you lie on it, it's called
Mortgage fraud.
Okay.
Okay. Not a fun thing. You can get imprisonment and fines for mortgage fraud. So definitely always be honest and do the right thing, I will say. It's a great resource for our veterans and active duty military personnel. And I would hate to see people ruin that option.
Yeah. Well, and I do like, because like you said, that somebody might have to move at the drop of a hat. So if you've been in a home for less than a year, then all of a sudden you have to move somewhere else. It doesn't always behoove you to sell at that point.
Right.
Just because I don't want to say upside down. I mean, we have a good market and all of that, but typically you want to have at least 2 years in a home before you move. That's just kind of a little standard rule of thumb for tax purposes and all. But I do like that, hey, you can't help this. We know your intent was to live here.
Right.
But we're going to go ahead and help you, hopefully, in your next spot.
We've had a real life situation as a mortgage company where somebody had orders to be here in the greater Charleston area, closed on a house 2 days later, got PCS somewhere else. After 2 days after closing. So again, not a circumstance that you can help. Like, had orders come down 2 days after closing that they never expected. But again, it's not something that person can help. The VA doesn't punish you in any way for that. One thing I do want to touch on is the VA funding fee as well. So there are different amounts of funding fees. So if you are a veteran and you are getting at least 10% in VA compensation monthly, you have no funding fee on your loans. You can use your VA loan as many times as you want. People have this misconception that it's a one-time use thing. No, you can use a VA home loan as many times as you need to. However, if you are a veteran and you receive zero in compensation from the VA,
and by that, do you mean like a disability type paycheck?
Correct.
Or retirement of
yes.
some sort?
No, not retirement. Disability.
That's disability. Straight, okay.
Disability. Or you're not a Purple Heart recipient, because I have had a Purple Heart recipient that was not getting compensation before. So Purple Heart recipients are eligible for a waiver of the funding fee as well. But if you are active duty or a veteran without any type of compensation, you will pay a funding fee. Now, the funding fee can vary. It can go as low as 0.5% to 3%.
Oh, wow.
And it's not something that you pay up front. It's added into your home loan, but it's going to be based on whether or not it's a first use or subsequent use. Are you putting any money down? Again, VA does not require that you put any money down, but if you do, it can lower that funding fee, especially if it's not your first time use of doing it. The other thing is this a purchase or a refinance? On a refinance, the VA does cut you a little bit of slack on the funding fee, I guess is the best way to put it. And that is The VA funding fee. That has nothing to do with your lender. It's going to be required based on what your eligibility and qualifications are. So just understand that
Okay.
as well.
So what all can be rolled up into your loan? So
For a purchase, nothing other than the VA funding fee.
okay, so if, because now we've got the whole thing with everybody having signed buyer agent and stuff like that. I know before they weren't were they allowed to pay agents previously?
No.
Okay, but they can now.
So that is correct. So the VA did finally come out with their circular stating that they were going to now allow buyers to pay for agent compensation. Previously, it was a non-allowable, but now it is.
And that's a cash out of pocket, cannot be rolled up as a closing cost.
Correct.
Okay, and so how about having insurance and taxes and all those escrow items? Are those things that need to come out of pocket? Like you actually have to have the cash to sit there?
The closing costs, yes. If you don't get any seller paid closing costs, yes, you have to have the funds for that. Now, obviously, it's going to be rolled in to your monthly payment. As far as we as a lender, we're going to collect all government loans, just a little tidbit as well. All government loans do require that you have an impounds or escrow account, which is for your homeowner's insurance and your taxes. You're not allowed to waive that. Only on a regular conventional mortgage can you. So we're going to collect monthly, and really it's as a benefit to you, a borrower, because we don't want you to have to come out of pocket multiple times a year, thousands of dollars for your property taxes and or your homeowner's insurance. And sometimes, depending on when you purchase your home, those two can hit you right at the same time. So because your homeowner's insurance is done basically every year from the 1 year of when you purchase, and your tax bills here in South Carolina, in our area, well, all of South Carolina is the same. Some states are variable. Some states where their counties can change, like they may do it biannually and some of them may do it annually. So, but in South Carolina, we're all the same. Our tax bills come out somewhere around end of October to, I would say mid-December, really at the latest. So if you buy during that time, if you don't have an escrow account, you're getting hit with thousands of dollars at one time. And nobody likes to put that kind of money out except for Christmas presents at that time of year. Vacations, Christmas presents, that kind of stuff. So it's very important that you have that. Now, if you're doing a refinance on your VA loan, then yes, you have the potential to roll certain costs into your loan if you wanted to, if you didn't want to pay out of pocket. Again, South Carolina, and every state is different, but South Carolina is an attorney state. So what that means is every real estate transaction must be closed with a real estate attorney. So you have to pay that real estate attorney as a part of your closing costs. Again, if you did not want to pay their fees for their title search, their closing letter, their recording of your mortgage and your deed and things like that, then you could pay that out of pocket, or you can choose to bump up your loan amount just a little bit and cover that.
Okay. So let me ask you this.
Okay.
If you have a situation where you know you're going to be moving from Seattle to Charleston and your family wants to come ahead of you, but you need to stay behind a little bit, will that count as occupancy?
Yes.
Okay.
There are definitely circumstances that will meet the occupancy requirement. So you're typically required to occupy the residence within 60 days. However, there are always exceptions. Again, family can satisfy that occupancy agreement. If there is an event occurring as to why you cannot occupy within 60 days, the VA can give approval for that. Real life situation, I had a client who was stationed over in Japan. The perfect house popped up for him. He wasn't going to be here for like 97 more days or something after closing, but we were able to go ahead and get closed on the house so he could secure the home that he wanted whenever he was going to be here. Already had orders and everything like that to come here, but again, was just going to be a little bit outside of that 60-day time frame.
Okay. And if you have the person who's kind of wanting to, I don't want to say set up for retirement because it's going to sound kind of, I don't want this to sound shady, but if they're kind of like, hey, I saw this duplex or this quadplex, I kind of want to buy this, we're going to live in one, maybe rent out the other one or the other three or whatever, is that a doable thing with a VA loan?
Yes. You can go up to a quadplex with a VA home loan. Again, you must occupy one of the units, and then we could even help to offset that monthly payment for if you needed it to be qualified with a rental schedule of what it would look like. So when we order an appraisal, there's an option for us to order a rental schedule to see what kind of income could be derived from those units based on comps around for rentals.
Do you use the whole thing or is it a percentage for the rentals? I've heard a lot of times that they can use like 75% of a rental so they can compensate for
I see what you're
vacancy.
saying.
Yeah.
Yeah. So 75% is all you do get to qualify for as a first time rental.
Oh.
So if you are an experienced investor or landlord, I was like, what is the word I'm thinking?
And I didn't even know what she was fishing for, so I was no help.
So if you're an experienced landlord and you have the property, like let's say you've already owned it for a while, and this is a little bit of a different situation, right? So let's say you've owned a property, but you want to use that property's income that you're generating. As long as you claim that income on your taxes, we can actually go based off of your taxes and give you full credit for it. Mm-hmm. If you are not an experienced landlord and you don't have 12 months of renting out that property, then, and it's for purposes of like just offsetting the debt, then yes, we do have an expense factor of 25% for potential times that may sit empty, any repairs or things like that that may have to happen.
Okay.
So
I know a lot of folks want to do that because I've even had people, I had a duplex listed and then people are like, hey, will they take a VA loan? We'll take any kind of purchase, but yeah, and that was for the same reasoning.
So again, we talked about having multiple VA home loans. You can definitely do that. That's not a problem. The VA works really simple with that too. The great thing about them is the only thing that's required in order to satisfy it is a signed lease.
Oh, okay.
So like, let's say that I'm currently in my home, which I have a VA home loan for. Again, my husband's a veteran, so we took advantage of using the VA home loan for our current house. So let's say that we wanted to depart our current residence, but keep it because we have a great interest rate on it and rent it out. All I have to do to be able to help offset that debt is to have a signed lease.
Okay. Now,
and again, 75% of the rental, no income since it's departing residence.
Right, which that's still nice.
Mm-hmm.
So talk to me about VA loans being assumable and whether, I know it's a good idea for a buyer, but what are downfalls for a seller and is there any
see my nose flare, y'all?
Yes, I was going to say.
So you are absolutely correct, right? So VA home loans are assumable. And it can be a wonderful thing for a buyer. Again, we went through this boom, we went through this market time frame where people have 2% to 3% interest rates on their homes right now. And it's very appealing to a buyer to be able to get into a 2 to 3% versus a 6 to 7% interest rate, right? Like we're talking about more than half, off the interest rate here. So it's a wonderful thing. They are assumable. Here's what you need to know. From the buyer's side, your seller's gonna have to submit a request to verify it's assumable, get the certain documentation, like what the payoff's gonna be and things like that, because they're basically going to transfer that loan. You have to qualify. You're gonna have to apply with the mortgage company that the current loan sits with. Nobody else can do it for you, only that mortgage company. And they're gonna transfer that once you qualify into your name, so you get to keep that interest rate in the remaining term, which is amazing, right? The downside to that as a buyer is, let's say I only owe $200,000 on my house, but I'm selling it for $350,000. You have to bring either $150,000 in cash or find other financing that will allow you to supplement that. And then again, they have to make sure that if you're financing the other $150,000 that you're going to qualify with the monthly payment that's attached to it for the assumable. As a seller, I struggle with this, honestly, because I think it is a great benefit to buyers. However, the downside to it could be anybody can qualify for a VA assumable. You don't have to be a veteran to do that, right? Mm-hmm. So if they are not a veteran, your entitlement that you have used up in that house is going to stay used up. it's not going to become available to you. If the person buying your home goes through a life experience and has a really hard time, and again, they're not a veteran, so that's not their entitlement being used, then you could potentially possibly lose entitlement for the rest of your life, you know? So that's where I struggle with it.
What if the buyer is a veteran?
If the buyer is a veteran, then you can do a request of the transfer of entitlement. But it's not always guaranteed that the VA is going to approve it either. So again, it's just, there's benefits, there's downsides, right? And you can't discriminate. You can't say only if you're a veteran can you take over this loan, because that's discrimination.
Right. It's either assumable or it's not.
Right. So that's where I struggle personally. And I think it's more of on a personal level I struggle, because I'm like, I don't, as much as it is a great offer, I don't think I would ever market my house as being assumable. And you're not required to. But I don't think I would ever do that because of the potential liabilities to the veteran.
It really is something that they've earned, and you don't want to lose it.
Right.
Being dependent on somebody else to fulfill their side of an agreement, because
Right.
whether it's intentional or not, things happen. The other question that I get asked is appraisals. People always think that the VA appraisal
I
is
gotta
just
stop
going to...
this. My nose starts flaring. On certain topics.
Yeah, well, because everybody thinks that the VA appraisal is just going to kill the deal, and oh, geez, it's going to come in 20,000 less. They're going to make me rebuild the entire house. And please tell us your experience with VA appraisals, because I know my experience, but let's hear it from the person who's getting the loans approved.
Okay, so can a VA appraisal be more restrictive than a conventional? Absolutely, right? But it's really no different than a regular FHA appraisal, right? Because they look for the same thing. They look for safety, soundness, structural, those types of things. So in my experience, again, my real life scenario I just gave you guys of my borrower who's upsizing, his appraisal came in $16,000 over contract.
Wow.
And it's a VA appraisal. No issues on the appraisal. I mean, again, every home is going to be different, right? If you know that you have like half carpet, half no carpet in a bedroom, that's a problem. But it's a problem for FHA too, right? South Carolina, we are required to have heat, but we're not required to have AC. Lord knows why. I don't know why. Because really, it doesn't get that cold here. I mean, I really preach another side of that story. I'm cold under 70 degrees, but it's still, I mean, for the majority of the South Carolinians, it's not cold. I'm just the unusual bird here.
AC is a bigger thing. Now, that's not to say that if a house has AC, it should work.
Right.
But if you get into like this really old house, it just has to have heat. It doesn't have to have air conditioning.
Exactly. So are there like little things? Absolutely. But again, it's really just the same as an FHA. So if you're going to be able to accept an FHA, then you'll be able to accept a VA. The only other difference is that a CL 100, which is a pest inspection, is required on all VA. We don't require, like, again, we're not required to get it on a conventional or an FHA, but it's going to be required on VA.
Which you cannot waive that. So sometimes a CL 100 down here is our termite inspection, our moisture inspection. And sometimes if moisture levels come up high, or if they find something, somebody go, well, you know what, it's not that big a deal, I want to buy the house. We'll just go ahead and waive that. You cannot waive that clause out of the contract for a VA loan.
Correct.
It's got to be corrected.
Exactly. And again, it's only looking out for the buyer and the veteran. Like, you know, and if there is moisture issues, resolve them, you know?
Yeah, you're going to want those fixed anyway.
Yeah. Like, I sold my house right here. When my husband and I had bought our house in Bunk's Corner, I sold my house in King Bay. I had, like, it completely normal. Like, the, I don't even know what it is, like the wood siding on the, like the garage door had moisture damage at the very bottom.
Yeah.
Completely normal where we're at, right? We are in a very humid, I mean, sometimes I feel like we're in a very tropical.
It's only rained for 2 days this time, just because it's supposed to start again tomorrow.
I mean, but we're in a very humid
It really
location. So, literally I replaced a piece of wood. I mean, that's all it required was I replaced it and had it cleared saying that we're good. The moisture levels are no longer there.
And you don't even have to replace the whole frame. You just cut out the bad part, put in the good part, make sure it's sealed and nice and painted and secure.
Exactly.
So they're typically easy fixes.
Yeah, so again, when people talk about VA appraisals, and I have not had any issues.
Now, and my other question about appraisals is, how does an appraisal, I know like FHA and stuff like that, and an FHA loan, it's going to stay with a property for 6 months, right? A VA, how does an appraisal work as far as being attached to a buyer, a home, etc.?
Yeah, so it's conventional, it's attached to the borrower. VA and FHA, basically your government loans are going to be attached to the property. So the only way that that property value could clear or be different, or you not have the same things come up on an appraisal, really is going to be to switch to a conventional lending. Because like, let's say you have a buyer who is a veteran, they're using a VA loan, they get the house appraised, and you guys can't come to terms on repairs or whatever it may be. If you put that house back on the market, you're not going to be able to accept like FHA or VA again, because that value is still going to be there, and then you're going to have the same issues. So you're really limiting yourself to conventional. It's always in your best bet, to go ahead and just make the repairs. I mean, in my opinion, because otherwise you're going to terminate. You're going to then have to put the house on the market again, remarket, and then get under contract, and then wait for the whole process to start over again. When at the end of the day, you could get some things fixed.
Yeah, and even if it's like a dollar amount, you have to look at, what are my holding costs going to be? Like, how many days was I at market already?
Do I have a mortgage? How many more mortgage payments am I going to have to make? Like, there's such a broader way to look at those types of things, I feel like, than people just automatically see that dollar amount of like, it's going to cost me $2,000 to do whatever. Like, it's going to cost you $2,000, but let's say your mortgage payment is $2,300, and you have one coming up that would have been paid off if you closed the loan, and then you're going to probably have another one that's going to come up due because of the fact that you're going to have to remarket. Right. So $4,400 to $4,600 or $2,000. Yeah. So I just I'm a numbers person, obviously, and I try and look at things a little bit differently and how it can benefit both the seller and the buyer.
And then appraisal wise, say there's, $2,000 discrepancy, not usually a huge deal. People aren't going to lose their mind over that. But what if it's like 10,000 or more, where it's really kind of hitting someone's pocketbook, but they're like, you know what, 2 other homes, the same style, same kind of condition, they sold for more. Is there any way that people can just be like, hey, and whose job is it to try to get the value up?
So that's the other really good thing about the VA that I feel like is that when we get a conventional appraisal or an FHA appraisal, it just gets done and it gets sent over, right? No notice of any issues or whatsoever, value, repairs, whatever it may be. However, the really good thing about a VA is that if your value is going to come in low, I don't care if it's $500 low or $20,000 low. If it's going to come in low at all, your lender is going to get a notification, and you have 3 days. It's called Tidewater. You have 3 days to submit supporting comps and what you used. And there has to be like really good reasons for utilizing those comps and really kind of seeing what the appraiser used. Because like, for instance, the appraiser may be using something that's a little bit better, closer in square footage, and even though one sold for a higher per square footage value, but are like 800 square foot more than the house you're doing, So we have to do that. But it's on your lender to notify the buyer's agent and the buyer, like, hey, we don't know what it's coming in low at. We're not given a value. We just know that it's coming in low. Do you want to submit this? Because again, it could be 500, it could be 20,000. We don't know. So it's really up to the buyer and the buyer's agent at that point to have that conversation. Like, do we want to submit these comps, or do we want to kind of just let it ride and see what it actually comes in at?
Okay.
But you have 3 days. There's a form that we can provide for you. Again.
So after you was gonna say, after you
Never had
get
that
the
happen.
number, you have the 3 days. So say I have a buyer and you're like, hey, this is looking like it's gonna come in low. I can at least gather my materials, and then if it's coming in, $20,000 less, and the buyer or the seller's just like, you know what, I'm putting it back.
Oh no, we have to submit the rebuttal within the 3 days. You don't have a chance to see what it's coming in at. Mm-hmm. Yeah.
Okay.
Yeah.
All right. So you either have to, wow, that's almost like a sight unseen kind of thing. But I mean, it's kind of a weird situation,
Right.
Because it's a catch-22 for a buyer, honestly,
Yeah.
and for a seller. Because if it's only $500, it's not a big deal. If it's 20,000, you might be like, I might be able to get this for a whole lot less. So why shoot yourself in the foot?
As a buyer.
What? Wait for it?
I personally would wait. And again, that's the buyer side of me. Please don't hate me, sellers. But the buyer side of me tells me, why would I want to pay more than what it's worth, right? So I would definitely not probably submit any comps, justifying why the value should be higher than what the appraiser thinks the value should be. And then secondly, if we are talking about like a $2,000 difference and it's not a big deal, the seller and buyer agree, great. But if we're talking about a $10,000 difference, then maybe we work with the seller. If I really, really, truly want this home, maybe we meet in the middle. The seller lowers the price $5,000 and I pay $5,000 out of pocket, because I can do that. I just can't finance over what the value of the home is.
Right.
So, and I've had clients, I do lie. I had one, it was $80,000 low.
80,000.
Yeah, but it was like $1 million home.
Okay.
So 80,000 on
So
the
it wasn't
perspective
like-
of $1 million isn't really that much, but I mean, that's what ended up happening. That was like when I very first started and I was a junior with somebody else. So that's what ended up happening, is we ended up kind of like not meeting fully in the middle, but the seller was willing to lower their purchase price or sales price, and then the buyer was able to bring some money to compensate, because they wanted the home.
Yeah.
They wanted the home.
Yeah, I actually I had a situation where we did that. We did wait for it to come in, and then once we got the number, I think it was eye opening to everybody, really. So the seller did agree to some, and then my buyer did agree to some. Yeah, it all worked out. I mean, everybody's happy. It's closed. They're still there.
Yeah.
It's a great house. And I think the other thing that you might want to look at too is kind of how competitive the market would be. Because if you were in a multiple offer situation and you really want the house and don't feel like going back out there, it might be worth it to try to contest it, so that somebody doesn't just say, well, you know what, I already had multiple offers. I went with yours, but I've still got, a backlog here and I know I can sell it. So I think situationally it depends.
Again, it does. And I think it depends on how much you want the home, right? Like, how does it check all of your boxes for you? Because most of us, when we're buying a resale and not new construction, and I learned this whenever I sold cars, right? I sold used cars. So typically you're going to get about 85 to 90% of what you want in a resale versus 100% of what you want in a brand new construction, right? So where do you lie on that scale of how much and how bad do you really want this home?
Yeah, that's true too. So
Yeah.
And even do you even have it to come out? I mean, sometimes, if you're doing all that financing, you might just have enough to cover your costs, and like, hey, you either have to lower the price or I just can't buy it. So there's a lot of situations.
Lots of circumstances, for sure.
All right. So I have one last question.
Okay.
How long does it take to close one of these bad boys?
I mean, it depends on how good you are. Me, 21 days. No, I'm just kidding. I'm just kidding. So, it really does depend. Like, I'm not gonna lie. It depends on your situation, the property, how fast do the buyer and buyer's agent move. Like, a lot of times I find myself that I move very quickly because especially in the pre-approval process, right? Yeah. And in my pre-approval process, I actually collect like pay stubs, W-2s, bank statements, all that stuff up front. So I feel really good about handing out a pre-approval for somebody. So I've done a lot of the legwork up front. However, and I move very quickly because I've had situations where people are like, oh, we're not looking for a couple of months. And then like 2 days later, like, we're ready to put in an offer. I'm like, we're not ready yet. Like, so I always urge my clients to move very fast in the beginning to get your pre-approval completed. The pre-approval is good for 4 months, right? Because that's how long a credit pull is going to be good for. And then we can go at your pace. But please understand, if you are asking me for a 21-day closing, you and your agent need to be on top of it for me, please. Because there's documents that the agents have to sign. There's documents that the seller has to sign. So, it's very important. I have one right now. It's a new construction. It's actually a save loan that I'm doing for a client. He's a veteran. 21 days, new construction.
Oh, that's nice.
Yeah. I mean, typical, you want to allow 30 days.
Okay.
That's your standard, right? I mean, 30 days, you have due diligence. You need to get your home inspections done. Even if it's new construction, get your home inspections done.
Yeah.
You need to get the CL 100.
That made my nostrils flare.
Get your CL 100 done. CL 100s are, which again, termite inspection, pest inspection, they're good for 30 days. Please do it up front, because if there is work that is found and needs to be completed, please don't wait to order your CL 100. I know most agents put 10 days prior to closing. We don't have time to get the work done most of the time at that point if you wait until 10 days before closing.
I get it. I start it like once we start the 30-day countdown to closing, then we go ahead and start doing that. Because like you said, it gives people time to make repairs if needed.
Right. So again, I think 30 days is a really good number. I can do 21 if the buyer and the agent are responsive.
Okay. And that is true, because I've given her people and I'm just like, what's going on? She's like, I'm waiting for documents, waiting for documents. So get your documents turned in if you really want to buy a house and move forward.
Right.
One last question. I'm sorry. I'm going back to appraisal real quick. And this is just because I had this happen, and it had nothing to do with the appraiser, lender, anybody. It was my client who was very impatient and kept doing everyone's
days.
job. Thank you.
$525 for the appraisal.
And that is an upfront cost that you have to pay. It doesn't get wrapped in later.
Right. You pay that up front with a debit card, not a credit card. We are required by law to give them 10 days without asking them anything.
Okay, so
to get it scheduled and completed and report turned in. So,
so if you order it on a Monday, they have 10 days to schedule it and finish
technically
it.
10 business days, so not that Friday, but the following Friday. So
Gotcha.
that's 2 weeks eaten up of your time.
Right.
So again, it's very, very important that you understand there are some things that are out of our control, out of your lender's control, that we have to follow. And that's just one of those things, but it can take some time for sure. I have some of them that come back like super quick. I had one that literally got flipped around in 3 days to me. And I was ecstatic about it, but don't expect that.
That's the exception to the rule.
Right.
I have found that they're usually closer to the 10-day mark, but like I said, I had a client and they were like literally that afternoon wanting to call the appraiser and find out. I'm like, dude, you gotta stop. And like going behind my back and you're like, I don't find out until after.
Yeah.
All right. Do you have any other words of wisdom?
No, other than just the VA home loan program is a wonderful program. So if you are a veteran, active duty, you have a family member, most people know somebody who has been in the military, if not several people who have been in the military. Make sure that they know all of their options available, because again, my husband was a perfect example. He thought he could only use it one time, and there's a lot of misconceptions, and I do feel like they're getting better about teaching that and putting those resources out, but just make sure that you speak to a VA lending specialist. I am a certified VA lending specialist. I've taken the class with the guy who actually wrote the VA handbook for lending, so I would love to be able to assist you. Again, thank you for your service, and I'm sure Cheyenne will have my contact information if you are looking to make a purchase in the state of South Carolina or Georgia.
For people who are like, hey, I love what she has to say, she can give you a referral in another state.
Yes, I can. I work for Carolina One Mortgage, who is what's called a joint venture of New Res. New Res is a huge mortgage company across the U.S. We have a lot of joint ventures. We're available in every state, I believe. So if there is somebody that you want to speak with, we do have referral partners all over the U.S.
All right. So fantastic. Thank you for your time. And if you guys have any questions, feel free to reach out to me or reach out to Danielle or any member of my team. We're happy to help.